All right, we're going to get started with our home buying workshop. Thank you so much for coming today. There we go. So first, before we dive into home buying, I like to start with what is a credit union? So if you're not familiar with what a credit union is, we provide not-for-profit banking products, loans, and services to our members. Credit unions are owned by their members who have a say in how the credit union is led and operated. So every member is an owner. So when you put $5 into your share savings, that is your share or your ownership of the credit union. And you are able to vote for the board of directors to have a say in how the credit union is run. The overall credit union difference is we are for people, not profit. A little bit about Zing Credit Union and who we are. Our mission is to educate, deliver, and achieve. We want to have a well financially educated community so that everyone can be reaching their financial goals. As I mentioned, we are a not-for-profit financial institution, and we have been serving the community of Denver and surrounding areas since 1934. So we've been around for quite some time. This class is a part of our financial education program. We have several aspects of our education program that includes our live classes like we're doing today. We also have recorded classes available on our website at myzing.com/recordings. This one will be up there, Create Great Credit, Protecting Your Identity, Wills and Trusts, and there's more on there as well. We also offer free one-on-one financial coaching. So you can sit down with myself or one of our other coaches, either in person or virtually, and discuss a variety of personal finance topics from, saving for a down payment, building up your credit, preparing a budget. And there's a lot more that we can discuss during those meetings. Lastly, we have our e-learning classes. These are available in both English and Spanish on our website. There's no download or email sign up required. There are about 5 to 10 minute modules, and there's a ton of different topics on there. All right, a little bit about how credit unions work. So first, you deposit your money with us into your checking, savings, certificate of deposit, you name it. And then we use that money to make low interest loans to other members. And then the profit made from those loans, it's not paid out to shareholders, or our board of directors. That profit is put back into the credit union and returned to you as a member by better rates on things like auto loans and mortgages and fewer fees. Credit unions, our overall goal is to serve our members and help out our communities. So a little bit about your presenters today. My name is JC. I'm the engagement specialist at Zing Credit Union. You can see my email there, jfinley@myzing.com. So if you do have any questions, feel free to send me an email afterwards. We can set up a one-on-one meeting, and I will go ahead and let Irene introduce herself as well.
Hi, I'm Irene. I'm a realtor with Compass. I've been in a residential real estate broker for about 22 years now. So work with buyers, with sellers, investors, first-time buyers, move up. So I am really glad to be here. I've done a couple of these classes with the credit union. I'm a proud member. I'm glad you guys are here, and I'll love to share all this information.
Awesome. Thank you, Irene. We're so excited to have you again. If you haven't attended our home buying workshops, Irene has helped us out for the last several that we've had to provide a really good market scope and insight to what we're seeing in the Denver market. So I'm super excited to have her here today. All right. Welcome, everyone. Diving into today's home buying content. Number one, this is one of the biggest purchases you'll probably make. It's a very big decision, a very big purchase. It has several steps, and there's several reassuring steps. So we'll kind of walk through what this will look like, what the inspection looks like, putting your offer in, choosing a real estate agent, and there are lots and lots of tools to help you along the home buying process.
Okay, I'm up. I'm going to flip over to share my screen now. Hopefully this works. Tell me, JC. Good?
Yes, and if you want, we can just stay on the same screen if you'd like to, just for easiness of moving throughout.
Okay, how does that work? Okay, can you see me?
Yep, good to go.
Okay, so, oh, you're saying you want me to just flip slides?
Yeah, that'll work fine.
Okay, sounds good. Yeah, so I just wanted to take a brief moment to figure out why we're all here and talk to you guys a little bit about the advantages and obviously the pros and the cons of home ownership. And this one is just really about why. What's the reason that we're all here? Is anybody want to chime into the chat and tell me what brought you here and why you think it is important to own versus rent. So I'd love to see that, and I'll see if I can bring that up on mine. JC, are you seeing some chats come through? Here you go.
I
Investing,
am.
exactly. Building wealth, equity. Exactly. So let's break that down a little bit. So the biggest advantage, obviously, as we've seen in the last couple of years, is that appreciation on investment that you have, which you don't have when you're renting. You have, your landlord's in control. They get to raise the rent whenever they want. It's really outside of your control. In the last couple of years, we've seen appreciation rates um, that are unbelievable. Obviously, the last 2 years we've had about 44% appreciation. That has slowed down quite a bit, which is great. And so I'm glad that we're talking to you guys now. And chime in the chat if you're a first-time home buyer as well, because it has been really tough for first-time home buyers, and now it has come around a little bit. So we're getting into a cycle where it's going to be a little easier for the first-time home buyer versus how it's been in the last couple of years. So you've got some tax benefits when you're a homeowner, as you get to deduct your property taxes and the interest on your loan. You get to build your equity. So if you're renting and paying about $1,700 a month on average in Denver, that equates to $20,000 a year. So in 5 years, you would have paid $102,000. And so when you own, you get to reap the rewards of when you sell that property, you get that and then some back. Also, it's a great way for generational wealth where you have an asset that appreciates and that you can pass down and be able to, renters are just at a big disadvantage when it comes to that. As far as the appreciation on investment, what I think is really interesting is that for as little as a 3% down payment, you get to buy an asset that appreciates for you, and you get to put down a portion of that. So it's only about, as little as 3%, or, if you have 20% down, that's even better. But there's no other asset that you can buy where you can put down a portion of it and get to utilize that equity to gain more on it. Like, for example, if you're buying a stock, you buy that stock for, let's say it's $100 a share. That is all that you get. With a home, you can buy a home that's $400,000, put down maybe $12,000, and you get the appreciation of that entire asset. Also, your rent won't keep going up. You get to have pets if you want. You get a yard maybe. So lots of really great reasons to own. And I'm glad you guys are all here taking this first step. So a little bit about the differences. I'm sure you guys probably already know this, but when you're renting, you get to call that landlord to fix whatever that needs to be fixed. You don't have property taxes or homeowners insurance, and you don't have those maintenance costs. When you own, you do fix things that come up, and every property is going to have things that come up. You get to pay the property taxes and your insurance as part of your mortgage payment, and then you do maintain the property and the land. But like we talked about before, your property taxes and your insurance, I'm sorry, your property taxes and your interest are tax deductible. So that is a pretty good benefit of renting that, of owning, I'm sorry, versus renting. All right, let's see. And you guys chime in with any questions that you have in the chat, and we'll answer those as we go along as well. So some things to think about as you are thinking about buying is really thinking about what if buying is really right for you and determining what you can afford. And so that involves really thinking about your budget and what you're currently paying for rent, what your salary is, talking to a specialist, a mortgage broker, or a banker, or the credit union, and getting pre-approved. And then having some money saved up for a down payment. That can be as little as 3% down. There are home buyer assistance programs that are available out there to help with down payment as well. So it's just really a matter of looking at your finances really hard, and getting realistic and figuring out what it is that you can and cannot afford. Then going about to select your lender, and I think it's really important to talk to a couple of different institutions. I really love the credit union. They, like JC said, are a nonprofit. They have people that really care about you and care about educating and making sure to put you in a program that makes sense for you. And then, talking to you more about down payments and things like that, and the different types of loans that are available out there. And then also the same thing with selecting your real estate agent. Talk to a couple of people, get some recommendations from friends, and figure out who really jives with you, who's going to be able to do a great job for you. And you want somebody who is readily available, is very communicative, and is able to educate you throughout the process. As
All
far
right.
That's you,
I
Jane.
will dive in here, Irene. Thank you so much. So looking at how much can you afford? So the standard rule is that your housing costs should not exceed 35% of your monthly gross income. And now when we say gross income, that means that the money you make before taxes, maybe your 401k, maybe you have an employer sponsored health plan that you're using. So your gross income is how much money you make before any taxes or any of that other stuff comes out. And that payment, that 35%, should also include things like Irene had mentioned, your taxes, property taxes on the home. Your homeowner's insurance should also be included in that. And then also costs like your private mortgage insurance and homeowners association fees that might be included. So private mortgage insurance, just to touch on that briefly, we will talk about it more throughout the class as well. But private mortgage insurance is an extra cost applied to your monthly payment if you don't have a 20% down payment. And like Irene said, most first-time homebuyers realistically are only putting down 3 to 5%. So as a first-time homebuyer, you will have that private mortgage insurance on your loan until you reach 20% equity in your house. And then homeowners association dues. Oh, sorry, go back really quick. Homeowners association dues, basically some houses will have an association that require you to pay a certain dollar amount. It could be $100, it could be $500. It will really depend on the neighborhood you're living in. It could be for some amenities, maybe like snow removal or lawn maintenance. We might see those more in condos or townhomes, but some standalone homes do have HOA fees as well. So just an important thing to look out for as you're looking at homes and what that might add to your monthly payment. Go ahead, Irene. So this is just kind of a real, an example to look at based on some salaries. So let's say your household makes about $50,000 in 1 year's time. Divide that by 12. You're sitting at around $4,167 per month. That's before taxes and all that good stuff. You want to multiply that dollar amount, that 4,167 by 0.35. And the reason we're taking that times 0.35, because that is 35% of your monthly income. So we want to see what is the most you should be spending on housing costs. So in this example, if you make $50,000, 35% of your monthly salary would be about $1,458. And on the right-hand side here, you can kind of see where your salary might fall and then what that housing cost might look like for your monthly salary. So this is just a good kind of basis to go off of, because you don't want to be spending more than 35% of your monthly income on your home. Otherwise, you can become what we call house poor. And that just means that a lot of your monthly income, or most of your monthly income, is going towards your housing costs, not allowing you to live your life in other ways. So yeah, this is just a really good example for finding out what can you afford. All right, looking at a real life example, Irene, I'm actually going to go ahead. Could you stop sharing this for a second? We did update this slide. All right, I'm going to go ahead and get this shared here. Sorry, guys. There we go. Sorry about that. Can everyone see my screen here? Irene, are we good? Awesome. All right, so a real life example, looking at how much you can afford. Let's say a home sells for $450,000. That is a typical price we will certainly see around the Denver metro. A down payment of 5% for a first-time home buyer is pretty typical. So about $22,500 we're putting down for the home. This loan has a 30-year fixed rate, so the term is 30 years, and the rate is 6.5% APR. So basically, we'll take that the dollar amount for the house, 450, minus our down payment, and that'll give us $427,500. Our monthly payment's going to be sitting at $3,265 per month. So that will want to factor in taxes on your home, insurance, private mortgage insurance, if applicable. In this case, it would be, since we only have 5% down, homeowners association dues if you have them. So here's kind of a breakdown of what those costs might look like. So your principal and interest payments are about $2,700. So that is what's going towards your loan. Then we have homeowners insurance. This is just a rough estimate here, about $150 per month. Taxes, $175. Private mortgage insurance, $238. Once you reach 20% equity in your home, that will fall off. You will no longer have that on your mortgage, totaling that $3,625 per month. So your total housing costs, so basically your mortgage, including your PMI, taxes, insurance, and any other debt. So for example, credit card debt, auto loans, personal loans, should be less than 43% of your gross income. Basically, we don't want to see someone spending more than 43% of their income on debt every month. Otherwise, we're seeing that they're basically half their monthly income is going towards debt, not leaving them with a lot to spend on other parts of their life. So that 43% should include your mortgage and then any other debt, and it's totally fine to be less than that 43%. In all honesty, it's better to be lower than or closer to zero than closer to that 43. And yeah.
Sorry, if I could chime in. We've got one quick question about financial goals like retirement. Should we account for those in that total cost in your budget? I think those would be, a different bucket from your housing costs. So your retirement costs, whatever you want to contribute towards retirement will be a different bucket from this 43%. Also, I do want to say that this 3,600 number might sound really daunting for some home buyers. And, just so you guys know, the rates have gone up significantly. They're at, around 6.5, maybe 6.25 right now. But, the prices are also kind of seeing a breather in that as well. Like our average price has gone down a little bit in the last couple of months, which is nice. So, it's not to say that you have to get a place that is $450,000 for your very first place. There are condos out there that are, much less and things like that. So, and then obviously, if you put down a down payment of more money or get some down payment assistance programs, then your payment will be a lot lower than that. So.
Thank you for addressing that question, Irene. I would totally agree that, financial goals like retirement, keep those kind of in a separate bucket from saving for your down payment for your home, or separate from your, monthly payment. Kind of align those goals a little bit separately. If you have a match with your employer, that is a great thing to take advantage of. It really depends per individual, what you'd like to save for retirement, what your income is, and what you'd like your spending to be after retirement. So that's a great question to ask. It really depends per individual. Thank you for addressing that, Irene. And there are special home buying programs for first-time home buyers, as we've been talking about, FHA loans, veteran loans, and adjustable rate mortgages. And we'll talk about a few of those now. All right, down payment requirements and private mortgage insurance. Here, we're just going to touch on that private mortgage insurance a little bit more. So basically, if you put down 20% for your mortgage, that will avoid private mortgage insurance. So 20% down means you don't have to have private mortgage insurance. I will say putting 20% down is rather unusual for first-time home buyers. A lot of times people are able to put down 20% because of the profits made from a previous home sale. So it is not uncommon for first-time home buyers to only be putting down 3 to 5%. Without that 20% down, you will oftentimes have to pay that private mortgage insurance. But one good thing to note is that private mortgage insurance will fall off, or you'll no longer have to keep paying that once you have 20% equity in your home. And we've seen the values, like Irene said, and around the Denver area really, really go up in the last few years. So hopefully you'll be reaching that 20% sooner rather than later to avoid that PMI. Here we've got a little chart on the right-hand side that kind of shows here, if you've got a house that's $400,000, 20% down is $80,000. So first-time home buyer, that could be pretty tough to save up to that dollar amount. So that's why they have those options for 3 to 5% down. All right, now we're going to talk about some loan options, the nitty-gritty stuff here. If you have any questions about these, feel free to plug them in the chat box. All right, so first we're going to start with conventional mortgage loans. So these are loans underwritten and insured by private lenders and investors. So these are like private mortgage companies, banks and credit unions, and so on. Down payments are as low as 3% or 5% for other borrowers. I've seen 3.5, 5%. I'm sure Irene can attest to this too. Anywhere from 3 to 5% is pretty standard for first-time home buyers. There is no mortgage insurance required for payments 20% or higher, as we just touched on. Borrowers with high credit scores and good down payments will benefit most from the conventional mortgage loans here. So ensuring your credit score is as high as possible can really make a big difference when it comes to interest paid over the life of your mortgage. So really make sure you focus on that credit score before applying, and then save up for that down payment. Don't spend it. Some government loans include additional fees or mortgage insurance requirements that conventional loans do not. So private lenders will set their own fees for conventional loans. So one thing to look out for, just keep an eye on any fees that you might have tacked onto your mortgage. One thing to note, that requirements are stricter for these loans, these conventional mortgage loans, because they are not backed or insured by the government like FHA loans. And we're going to talk about those here in a second. Conventional mortgages put lenders at risk if a borrower defaults. So that means if I, take out a mortgage, I only put 3% down, and then I stop making my payments, that's directly on the mortgage company or the bank or credit union. They're not going to get paid out from the government or anything like that. And that's the reason we have private mortgage insurance. All right, FHA loans. So a few features of FHA, it stands for Federal Housing Administration. So this is a federal option for your mortgage. A few features. So loans are limited and it will vary by county. So you do have to look at what county you're in. I am in Adams County, that's where I live. So mine might be a little bit different than this Denver number here. So basically this caps out how much you can spend on your house. So in Denver County, you can spend up to $684,000 for a single family home. This is still a pretty good number here. You can get a pretty nice house for this dollar amount. Upfront mortgage insurance is required over the life of the loan. So one thing to point out here is that your private mortgage or your mortgage insurance will not fall off. It will be on there for the life of the loan. You can anticipate that to be typically 1% of the cost of the loan. So one thing to note here. Basically non-cancelable mortgage insurance. So that is kind of the one downside or downfall of these FHA loans, is that private mortgage insurance or mortgage insurance will not fall off. It will be on there for the whole loan. The borrower is not required to be a first-time home buyer, which is good to note, but you cannot have owned a home in the last 3 years. So if you've owned a home, but it was many, many years ago, this would be a program or a mortgage loan you could still qualify for. Gifts and grants are permitted as a source of funds for down payment and closing costs. We'll talk about some resources in a little bit where you can maybe look for some down payment assistance. And then non-occupant co-borrowers are allowed. Basically, that just means that someone that's not living at the house is allowed to co-sign on that loan there. So they don't have to be living there to co-sign for the mortgage. A few benefits of FHA loans. Why would I choose one of these? Number one, down payment at 3.5%. So very, very low. This may allow you to buy more house because you're not having to put near as much money down. You can be used for purchasing and refinancing. So you don't have to just be buying the house for the first time. You can refinance with an FHA loan as well. And then less cash on hand may be required by the borrower, hence that 3.5% down payment.
And also you don't have to have as high of a credit score to qualify for FHA loans. So that's another reason that people go with these. And they, lately, because our housing market has gotten a little bit better for buyers, especially during this time of year, you're able to maybe negotiate some of those upfront costs, like the upfront mortgage insurance premiums, to be paid for by the sellers. So FHA loans we haven't used them for a while, but now they're kind of coming back, and a lot of borrowers are using FHA loans to be able to get into a home.
Awesome. Thanks, Irene. That was great information to share. I did see someone has their hand up for a question.
Yes, I have a question. So say you have a payment of, let's just say $2,000, right? And you have mortgage insurance attached to that. If you refinance your payment, will that mortgage insurance go down? Because you said it was 1% of the loan. So would it go down if you refinance, or would it just stay the same?
Do you want me to take this, Jason?
Yeah, Irene, if you want to go ahead, that'd be great.
When you refinance, if you have 20% equity in the property, then that mortgage insurance, then you can refinance out of the mortgage insurance.
Oh, okay. I thought it didn't drop off.
Well, when you're refinancing, you're probably going to refinance from an FHA to a conventional loan.
Okay.
Or if you decide to stay with FHA, which most people won't, if they have 20% equity, they'll go into a conventional loan. And then that mortgage insurance drops off once you refi.
Perfect. Thank you so much.
Yep.
Of course. Thanks for taking that one, Irene. Basically, in short, if you have an FHA loan and you want to get rid of that mortgage insurance that's non-cancelable, you can refinance from an FHA loan to a conventional mortgage, and that will get rid of that mortgage insurance. So basically, you just have to refinance, which can be a task. Rates have to be a good match and all that good stuff. But if you refinance from an FHA loan to a conventional loan or another loan, that will remove the mortgage insurance. So great question there. All right. Oh, you have another question?
Sorry,
Go ahead.
a plug for home ownership is that this refinancing is something that is a huge benefit for being a homeowner versus being a renter, because obviously the rates are high now. If we go into a recession, which there's a lot of talk about, obviously, and then if the Fed does, lower the rates at some point within the next couple of years and you get to refinance, you get to benefit from that. And, as a homeowner, your mortgage payment will go down quite a bit if the rates go down, versus as a renter, your chances of ever getting lower rent are slim to none. Okay, sorry.
No, absolutely. I think that's a great point to bring up. I know the rates can seem scary, but refinancing is always an option, and we see rates go up and down all the time. So, yeah. All right, hopping into VA mortgage loans. So these are specifically for veterans. So if you're a veteran who served 90 days consecutively during a wartime, 180 days during peacetime, or 6 years in the reserves, that would qualify you for a VA mortgage loan. If you are eligible, you are able to purchase a home with no money down and no mortgage insurance requirements. Two big barriers. So, having to save up for that down payment can be a lot of work. That mortgage insurance does add, a couple hundred, if not a few $100s to your monthly payment. So if you can qualify for a VA loan, they have some great perks. These can be an excellent alternative for U.S. military veterans. VA does have strict requirements on the type of home you can purchase. So number one, the home must be your primary residence. It can't be a vacation home or, a mountain cabin or anything like that. You have to be living there as your primary place. And it must meet minimum property requirements. So you can't be buying, a fixer-upper that you're planning to fix up and then flip it and sell. It does have to meet certain property requirements. No fixer-uppers allowed, unfortunately.
Well, but fixing, it can't be.
Fixer-upper is per person, right?
There's, if it needs some cosmetic and things like that, it's fine. It's similar with FHA. There are going to be it's going to be a little bit more stringent with health and safety things, but
yeah,
you can still get something that you can, upgrade as you live in it. So.
Yeah, absolutely. It doesn't have to be, a new build or brand new home or anything like that. Probably just, needs to have a good structure, not asbestos filled or anything like that. A few nonprofit resources that could be a huge help if you are looking for some more resources or just additional information. One is CHAPPA, which is Colorado Housing and Finance Authority. Their website here is chfainfo.com. They have help with home purchase loans. So basically they can offer you a loan for your down payment. They have home buyer workshops that are HUD approved. Also available in Spanish, which is awesome. I know we do not have a class available in Spanish, so CHAPPA could be a good resource if you're looking for Spanish classes. FHA or CHAPPA loans that have an educational requirement, grants or loans for down payment and closing cost assistance. I highly recommend always looking, for grants or scholarships for down payment assistance. Just kind of going out. CHAPPA has a ton of information about those. Low income rental housing, income limits do apply here, but if you are looking for low income housing, CHAPPA has a bunch of lists and resources there. And then also foreclosure prevention resources. No one wants to buy a home and then foreclose on it down the road. So they have some resources if you're concerned about running into that situation. A few other ones here, Colorado Housing Connects. They connect client to free resources across Colorado, whether it's nonprofit resources, government agencies related to home ownership, whether it's counseling, foreclosure prevention, renting help, whether it's landlord and tenant disputes, eviction help, home repair and maintenance, especially for seniors and those with disabilities. Help them kind of maintain their lawn. Maybe they need a smoke detector replaced in their home. Reverse mortgage counseling, if that's something you're interested in. Fair housing, housing discrimination related to home buying, financing, and renting, and then affordable housing such as Section 8. So good tips when going through the mortgage process. A few do's and don'ts. Do keep in constant contact with your lender. These are the people getting you in the door to your home. They're providing you the money to buy this place. So keep in constant contact with them. Send them any new bank stubs, payment information throughout the process. So if they say, hey, we need another pay stub from you, send it over there as soon as possible. Deliver all documents to your lender as they request them as timely as possible. They're doing their best to get you in the home, and they need all that information to finalize the application and get you pre-approved. A few don'ts. Do not do these as you're looking at houses or planning to buy. Number one, don't incur any new debt. We don't want to see you applying and getting a new car loan right before you're about to buy your new house. We know sometimes happens, you get in a car accident and you need a new car. Talk to your lender and figure something out there, but you don't want to incur any new debt if you don't need to. Do not spend your down payment. If you tell your realtor or your lender that you have a certain dollar amount saved, do not come in a few days and say, hey, we actually have half of that now. They're not going to want to hear that. Don't change jobs. As a lender, we like to see 2 years of consistent payment history when you're looking to buy a house. It is one thing if you want to change jobs within industries. Let's say I go from, one credit union to another, that's okay, but they don't want to see me go from, a credit union to doing sports trading because I've never done sports trading before. And then don't make changes to your credit that could impact your loan being approved. This could be something like applying for a new loan, not making your payments on time, dropping your score, anything like that. So you want to make sure your credit score is as high as possible so it doesn't impact your loan and your pre-approval. A few other costs to plan for. Closing costs. You should estimate that closing costs are going to be about 2% of your purchase price. It does not include prepaids. So for example, the buyer, what are you going to be paying for as the buyer? You're going to be paying for the appraisal, the inspection, which is very, very important. I'm sure Irene will talk more about inspections. Your down payment you will have to provide. Earnest money, which is basically money you'll put down with your offer. This is to show the sellers that you are serious about buying this home. But one note is the buyer does not pay the realtor. So as a buyer, it is only to your benefit to use a realtor. They're going to be basically your best friend when it comes to the home buying process. The seller, they're going to pay for the title insurance and all realtor fees, which is usually 6%. Both parties will contribute to the closing costs. I think when things were super crazy here, a year ago, we were seeing primarily the buyers covering closing costs, but I do know in a market like now, or when things are a bit slower, you do see both contributing. And then other fees may exist depending on the home, such as an HOA fee, transfer fees, flood insurance, depending on where you live, and so on. Irene, do you have anything to include on closing costs here?
Just to say that since the market has shifted a little bit, that buyers are sometimes getting those closing costs paid for by the seller, which is a really huge advantage right now. That wasn't happening just a couple of months ago.
Yeah, absolutely. I did see we got a question here in the chat box. Is there a target credit score to have for your first home purchase? At the credit union, we say a score around 700 is a pretty healthy score for, getting new loans and things like that. It's always good to work towards the highest credit score possible. The highest is 850. I mean, realistically, only about 1% of Americans have a score, I think, above 800. So you don't need to have an 850 score. At the credit union, we say around 700 is a pretty healthy score for getting loans. Irene, do you want to take this next question?
Sure. what do we got? So this would be in addition to down payment. So let's say 5% for the down payment, additional 2%. Yes, though that would be an additional for closing costs. So those costs, you know, range from your appraisal, your like some title company fees, your loan closing fees. That's what that 2% is about. So yeah, you can count on about 7%. But like I was saying, in this market, depending where you're buying and all these different variables, you may get those closing costs paid for by the seller now.
Thanks, Irene. All right, you're up.
Okay, so now that you have gotten pre-approved, you hopefully know what you can afford, and then you have your realtor picked out so they can show you the right houses. And then it's necessary to make an offer to show a seller that you're serious. You don't have to wait to do a lending pre-approval when you find the house. So there's some resources on where to apply if you wanted to work with Zing. And then, you know, your realtor will likely set you up on a search. I'm sure that you guys have all been looking on the Zillows and the other real estate sites for homes, and you guys come up with a good list. Usually we take people to see around 5 to 6 properties at a time. Back a few months ago, there weren't that many properties out there, but now that things have shifted a little bit, there's more available and the inventory has loosened up. So that's really nice. You have more choices there. So then once you're approved and you pick your real estate agent, and then together you guys determine your housing priorities, what's important to you. There should be a good list in your packet on how to prioritize those. You know, one of the biggest things that I like to ask people is about their lifestyle. How do they live? What is important to them? Do they have to commute to work? Do they work from home? You won't obviously ever find the home that meets every single one of your priorities. So it's really important to compromise. And maybe I've seen buyers come up with, you know, really intricate spreadsheets on listing out their priorities. So once you do that, and then we go out and we look at houses, you definitely don't want to look at anything until you are pre-approved and have that pre-approval letter in hand from your lender, which involves giving them some financial information, a couple years of tax returns, letting them know if you have debt, student loans, or car payments and things like that. So once we go out to look at houses, then if we find one that works, we write an offer, and that process can take, you know, as long as people need. But from making the offer to closing day is usually between a 30 to 45 day time frame. So keep that in mind. It's always best to be in a situation where maybe you're renting, but you're going month to month. And that will help you a lot with negotiations and things like that.
We do have a few questions in the chat box that I think could be a good time to answer them. So we have one here that says, how soon should you apply for a pre-approval if you're wanting to buy a home in about a year?
That's a good question. Pre-approvals typically last 90 days. So keep that, you know, that time frame in mind. But that's not to say that it's never too early to engage a real estate agent or a mortgage person, because you can ask them questions, get lined up, figure out where your credit is now, what kinds of changes that you might need to make, and then, you know, obviously help you save for a down payment and things like that. So that's kind of the time frame.
Thank you, Irene, for that you can apply for pre-approval and then re-extend it. So every 90 days you provide your most recent pay stubs. If you've filed taxes in that time, your most recent W-2s. I did that several times with the credit union, and I found it really helpful before I was ready, so that I knew what I could afford within my income, could, you know, do some budgeting, planning, preparing, saving more for earnest money, closing costs, and so forth. They do pull your credit every time that happens. So that's something to keep in mind, but it is helpful and you are able to re-extend it as long as you stay in communication with your lender and continue to provide those supporting documents.
Yes, very good point, Sarah. Thank you.
We have another question here. As a first-time home buyer, how do I make a competitive offer if I don't have a lot of earnest money, a low down payment, and I don't want to waive an inspection?
Okay. It's a tough one, huh? That is okay. I mean, it just really depends on, where you're looking, how competitive the market is in that area. And real estate is so hyper local that it just really depends. You could have a house that's been on the market for a couple of weeks and people will be okay with, sellers might be okay with accepting some of those things that maybe they weren't okay with accepting before. I would never recommend a buyer to waive an inspection. I know that was really popular and happening quite a bit a few months ago and not so much now. So you're in a much better position to be a first time home buyer right now. And I say get your resources together, get your team together, your realtor, your lender, and just get out there.
Yeah, and in addition to what Irene said, I think, getting pre-approved is another good thing. If you go in with your pre-approval letter, the seller knows you're very serious about buying. And then also having a strong credit score, that will also make a difference when it comes to your loan, getting pre-approved, all of that good stuff. And we did have one more question come in before we move on to the next slide. When do you actually lock in your interest rate for the loan?
Well, it depends. So you have to have a contract on a house. So it has to be after you contract on a house, and it can be any time after that. So you'll work closely with your lender to kind of monitor the market and hopefully lock in, a pretty good rate. You can do that within the first couple of days of going under contract. You could stretch it out. Of course, we don't like people to stretch it out too long, but you do have a little bit of time after going under contract.
All right. And then we did have one more question come in. Sarah, you might be the best person for this question. Who does the biggest down payment grants or assistance for first-time home buyers? I know CHAPPA does a lot of options or has options for down payment assistance and grants, but Sarah, I know you're kind of our out resource wizard. So do you have any suggestions for this question?
Yeah, that's a good question. It really varies depending on the grant funds that are available. So different nonprofits and organizations have these waves where they have funding and then the funding is available until it's all claimed. So it really, really varies. I couldn't give you a specific, but Colorado Housing and Finance Authority, which JC mentioned, the acronym is CHAPPA, is a good one. And I say, use that Colorado Housing Connects resource because as grant funds become available, that resource is aware of them and can connect you to different nonprofit organizations. Sometimes banks behave very badly and have to pay a fine in the form of grant down payments, and you don't have to necessarily go through a specific bank that misbehaved with their mortgage lending practices. So that will happen from time to time. Those are some of the highest I've seen that didn't have to be paid back, a grant as opposed to a loan that's due at the sale of the house.
Awesome.
Yeah,
Thank you,
really
Sarah.
good question. Sure.
All right.
Okay, moving on. So as far as choosing a real estate agent, what a real estate agent does is they're your trusted advisor. They guide you throughout the process. They help with the negotiations. They write contracts. And we basically just look out for your best interests. A realtor is somebody who has taken the ethics class. We are members of the Association of Realtors, and so we're at a higher level of standards than just a real estate agent. So you might want to ask your real estate agent if they are a realtor. Could be one of the questions. As far as paying an agent, I know JC said that it is paid for by the seller. Typically, we work on commission only, and it typically is paid for by the seller. 99% of the time it is. Sometimes there are small percentage of cases where a buyer may be required to pay their broker, depending on if the seller is using a discount broker and they're not paying a full commission. But those are all just one-off cases, and we can discuss those and figure things out within our working relationship together. So make sure you interview your future agent and make sure they're going to be the best person for the job for you. And then there's some good questions to ask your realtor in your resource guide. Did they get that on email?
No, the resource guide will be sent out via email after the class with the class recording. So I apologize, you all do not have that in front of you today, but it will be sent out with the class recording. So you have an idea of, good questions to ask your realtor. Also, finding those important housing requirements as well. There's a really good checklist in there. So you will receive that after the class later this week.
Cool. JC, let's, since we're kind of running short on time, let's skip over to a couple slides to the make an offer.
Yeah, absolutely. So these housing priorities, these will be in the packet as well. Just a big list of things that you will want, not want in your future home. Very clear to communicate that to your realtor or real estate agent. Rate these houses on a 1 to 10. As I said, you will receive this in an email. So this is the important slide.
Yeah. So it's kind of the meat of what the transaction looks like. Once you do go under contract and you make that offer and you do go under contract, you are required to put forth earnest money, and that just shows you're serious about the house. It's usually about 1 to 2% of the purchase price. It's listed out in the contract. That amount is negotiable. There are suggested numbers within our MLS when you go to look at properties. So your agent will be able to tell you they're asking for X amount for earnest money, but that amount is negotiable. So if you don't have a lot for earnest money, don't worry about that. It's really money that gets set aside. It sits with the title company. You as a buyer, once you go under contracts, have a lot of control and a lot of outs within the contract. So that earnest money is safe and it sits with the title company, gets applied to your down payment at the end. Then also in the contract, there are dates and deadlines as far that we need to meet as far as your inspections go, your appraisals, and your loan approval. And so your inspection is one of the biggest outs that a buyer has in the contract, and you want to make sure that we keep that as a contingency. And typically we do a general house inspection, a sewer scope, and a radon test, and hopefully not a structural inspection. But if your general house inspector recommends it, then you may want to consider doing a structural. But basically, this is about protecting you, the buyer, and making sure that you're not buying the money pit house. And so you get to have that inspector who works for you go top to bottom on the property, take a look at the roof, crawl spaces, basements, garages, slabs, all of that stuff. And they write up a report, and you have the option at that point to say, wow, there's too much work that needs to be done, and you can terminate the contract. You get your earnest money back at that point if that happens. But typically it might not. It probably won't be that damning. So we can write up a list of things that we would like the seller to address. We submit that as an inspection objection, and then we negotiate that just like when we negotiated the contract. And we try to, and we as realtors, as your buyer's agent, really act on your behalf to make sure that you're represented properly and that all of those items are addressed that are of a concern to you. And then same thing with the sewer scope. They send down a camera into the sewer line, making sure that that is okay. And then the radon test is just a test that sits in the house for a couple of days, measures radon levels. And if they are high, then we ask the seller to mitigate that, and really just involves putting in a van. It's about $1,200 to $1,500 cost for the seller. So that is all about inspections. I know we're getting a lot of real questions in the chat. Should we address those, JC?
I see we just had one that came in that said, how do you find a good and reputable inspector? Do realtors help with that? It looks like Sarah said yes. If you want to add anything on top of that, feel free.
Yep, definitely. We usually provide you with a list of inspectors that you're free to use, or use anybody that is recommended to with you. Then once we negotiate those inspections and we go to the next step, which is appraisal, and we get that the appraisal is ordered by your lender, and the property does have to appraise for purchase price and hopefully a little more so that you have some equity. But if it does not, then we do have an issue and we go back to the seller typically and ask them to reduce the price. In the past, you guys are at a better time of year now where sellers are more apt to negotiate, but back in the past, they wouldn't be. And so when properties don't appraise, then buyers end up having to bring more money to closing table. So that was happening a couple of months ago, but and also in the springtime, because of our run up on prices, that's when we have more troubles with appraisals versus right now. And so right now, the fall through December is really your best opportunity from being a buyer, for being a buyer in this market. And I would highly recommend, if you guys have a little money saved up for a down payment, to take the next step and engage with a realtor and a lender and work on the next steps there. And then sometimes, then closing day. Then we go to closing. Then your loan is approved because hopefully you're approved on the front end. The house gets approved because of the appraisal comes back fine. And then we go to closing day. The title company conducts the closing. You sign all the papers together. The money transfers on that day, and typically you get possession that same day, depending on if the property is vacant. If it's not vacant, the possession date is negotiated as part of the contract, and sometimes there's a post-closing occupancy agreement where the seller may want to rent back or stay in the property for 30 to 60 days. So that's why being really flexible as a buyer is really important as far as your timing goes, and that you're not locked into a lease. Oh, yes. And these are our Denver market stats right now. You can see that our sold listings sit out at 4,300 in August. That has gone down year over year by a quarter. New listings have gone down year over year at 5,400, but our average days on market has gone up. We're up to 19. That was seven days just a few months ago. So that is a good number to watch, because then that means that the buyer, it's shifted a little bit into the buyer's favor. Average sales price is up 7%, which is a lot, but not as much as years past when it has been in the double digits. And then we do have a 2-month supply of inventory, which is nice because we've had less than a month for a long, long time the last couple of years. So things are looking up for buyers. And like I said, if you guys are at all thinking about it, at all capable, I would say engage in with a realtor and a lender as soon as possible. And we can also hang out. I know it's 1 o'clock, but we can hang out and answer other questions for you guys. If anyone has any, feel free to unmute and chime in or put them into the chat.
We did have a question come through, kind of on the chunk of the procedure slide. Could you speak to what an appraisal gap is? I know you're kind of talking about appraisal on that slide. So.
Yep. I can definitely tell you about that. And in the springtime market, which may happen again in this springtime market, but maybe not. But in the last couple of years, those have been very, very popular, where because appraisals were not keeping up with the market, and so appraisals were coming up short. So a lot of buyers were put into their contract to the seller to say, hey, if the property doesn't appraise, I'm okay with paying the difference. So if you wrote your contract for $500,000, you could say, if the property doesn't appraise, I'm willing to pay up to that difference. Or you could say, if the property has to appraise for at least $450,000, and then I'm bringing an extra $50,000 to closing. So those are all things that were negotiated as part of the contract. it's a really hard situation for buyers to be in, and that's why we did not have a lot of first-time home buyers in the market, was because of these appraisal gaps and inspection waivers and things like that a lot of buyers were putting into the offer. So I hope that makes sense, but I'm happy to talk to you offline more about it. But like I said, these days we have moved away from those, which is a really good benefit for the buyers.
Thanks, Irene.
Yeah.
Yeah, we will hang out if there are any other questions. If you don't have any questions, you are free to go, and thank you so much for attending. Like I said, we will be sending out a recording via email. So we will have that and the resource packet there. I'm going to go ahead and stop the recording today, and we can answer any more questions now.
Yeah. Oh, thanks for all